Imagine Warren Buffett had a time machine. What if he could give himself advice when he made his first investment at 11 years old? What kind of stock-picking advice would he give himself? Believe it or not, this advice is not secret knowledge. Buffett gives this same advice out for free. He writes his thoughts down in yearly investor newsletters. But what are the top principles he uses for finding investments? How does he think about the stock market in a way most people don't? Let's explore the top strategies Warren Buffett uses to pick stock opportunities. Find long-term plays. When Warren Buffett was only 6 years old, he started saving up money for his first stock. By the age of 11, he'd saved $114. Deciding to go all in, Buffett put 100% of that money into a company called City Service. It was an important day for Buffett. He even remembered the exact date, March 11th, 1942. He later said, "I had become a capitalist, and it felt good." But he'd also made a mistake, he thinks, because if S&P index funds had been around back then, that stock would have eventually been worth $600,000 or more. If given a time machine and an S&P index fund, Buffett would have told his younger self to invest differently, to buy in the stock market in general, hen hold forever. Since we have index funds these days, maybe that should be good enough for us too. But what about individual stocks? Look for evergreen companies with products and services people will still need in 10 years. Will people still use American Express in 10 years? Coca-Cola? Probably. What emerging companies can you see people still using in 10 years? If you can't imagine holding a stock for at least 10 years, reconsider whether you're an investor or just a day trader. Understand the business. Buffett believes in investing in companies whose business models he understands. He understands Coke, so he buys Coke. He focuses on industries and sectors that he's familiar with, as this enables him to better evaluate a company's competitive advantage, risks, and potential for growth. It's not that he thinks there are zero opportunities in industries he doesn't understand. It's that he's smart enough to understand his own psychology. If he doesn't understand a business, his blind spots get bigger. That makes it harder to evaluate the risks. Pick businesses you understand to keep blind spots to a minimum. Over the years, Buffett has missed major opportunities, like getting in early on Apple. But if you end up with $100 billion anyway, maybe it's worth sticking to what you understand. Competitive advantage, Moat. One of Buffett's key concepts is the economic moat, which refers to a sustainable competitive advantage that allows a company to maintain its market position and fend off competitors. This advantage can arise from factors such as brand recognition, cost advantages, network effects, or strong customer loyalty. Buffett loves Apple, which is one of the most well-defended brands in the world. Not only does it have a substantial cash position, reportedly over $60 billion in cash on hand, but it has tons of brand loyalty. Customers aren't abandoning those Apple products anytime soon. Margin of safety. You've heard of buy low, sell high. Another way to think of this is only to buy a stock when it's cheap. Buffett insists on having a margin of safety when purchasing stocks. This means he wants to buy stocks at a price significantly lower than his calculated intrinsic value. Even if he's wrong about when the stock is going up, this means that the long-term trend should support growth. Management quality. Buffett always looks for high-quality executive leadership in a company. He looks for businesses led by competent and honest management with a proven track record of making wise capital allocation decisions. So how do you know when a company has wise leadership? Watch them. According to Buffett, there's a simple hack for looking at company leadership. See how they treat their investors. Just like you might judge a date from how well they treat your server, check out a CEO by how well they treat shareholders. Read their letters to stockholders. You want to figure out how well that they treat their owners, Buffett said. Read the proxy statements, see what they think of. See how they treat themselves versus how they treat the shareholders. The poor managers also turn out to be the ones that really don't think that much about the shareholders too. The two often go hand in hand.